taking our time. Going over the Fed minutes. Let's see if anything changed. We'll look at the data. We have inflation coming up pretty soon. So let's get into it. First, I'm going to read the sections of the Fed minutes before we actually hear Steve Leisman on CNBC go over it. We can delay that. That's totally fine. We can delay that. We can listen to it. But first, let's read if anything changed here for the release. This is just on Twitter, breaking market news. So we're going to go over that really quick. First Fed minute. Some participants indicated they favored or could have supported raising rates 25 basis points, whatever. That's a net neutral. Nothing really changed there. Okay. Almost all participants judged it appropriate or acceptable to leave target rate unchanged. So at least the target rate, I think, is 5.6, 5.5. They're keeping that still. So a lot of trickery here. They're going to keep that. They voted to keep the target rate still, but none of this really matters going forward if inflation comes in lower than expected next week. So again, we're just, going over the data. We don't know what's really going to happen or if that's actually going to make a difference. So let's just read through this and see. And then we'll go over to Steve Leisman and hear what he has to say. Almost all participants stated that upside risk to inflation outlook or possibility of inflation expectations might become unanchored, remained key to policy outlook. Again, depends on the inflation numbers next week. Resolution of the debt ceiling had removed a source of uncertainty. Okay, cool. Interesting. That's big. So a number of the participants, which is probably generally most of them, had stated that the debt ceiling resolution removed a lot of the uncertainty for the market. So for the Fed to acknowledge that is pretty huge. And remember, that's when the S&P broke out. Once that debt ceiling resolution came online, the S&P pushed the shorts out of the way. So the Fed is now acknowledging that was a big potential risk off the table, which I said, hey, that was the biggest risk. Now you have people saying the TGA refill is a big risk, but we know that liquidity is just coming from the reverse repo market. So it's really net neutral and still positive for risk assets. So far, I'm not looking at the S&P. Let me pull up the S&P really quick to see how it is responding as we go through these minutes. We are going to be a little delayed, obviously, because we want to make sure we analyze this correctly. Okay, it's pretty volatile. It's moving up and down. It looks usually how the Fed looks, right? There's initial squeeze up, big buy orders coming in. Now it's looking like it's going to sell off. So let's keep reading here. Oh, very interesting. They actually mentioned the reverse repo facility. Okay, Fed minute. Few participants noted potential for upward pressure on money market rates as Treasury increased bill issuance, which might lead to lower use of the RRP facility, which means basically, I guess what they're saying here, this is kind of risky. This removes liquidity. And what they're saying is if the Fed does hike rates, then the money market fund at the reverse repo, basically the money parked at the reverse repo facility will become more attractive because it's yielding higher rates. It's yielding higher interest to those people who park their cash there. And if that is the case, while it sucks liquidity from it sucks liquidity out of the treasury, the money that should be going in the treasury, it sucks that liquidity back into the reverse repo, which would undo the liquidity neutrality that we've been talking about. It basically suck liquidity out of the market because when you increase rates, that cash is going to get more yield at the Fed, right? So basically the U.S. Treasury, on ramp or supply of U.S. Treasuries is going to have to be taken up by the banking sector, which would remove liquidity from the banking sector. It's really complicated, but the point being that this is a net negative because it would lead to lower reverse repo, lower use of the reverse repo facility. We want the reverse repo facility to be used. Very, very, oh my God, that's very complicated there. anyways, we could pull up the minutes, but that's a lot. So we'll go into Steve Leisman. Anyways, that's a big acknowledgement. I think the biggest thing there, they're actually acknowledging that the reverse repo facility might become a net negative or a net positive. I think it's still a net positive. I still think people, investors are, and whoever it is at the money market funds, they're going to try to collect cash from those T-bills, those short-term rates, 6 months, because you can always renew it. You could always roll it over. What's going on, ROIV? We're just looking at the Fed minutes. We're trying to decide just what the Fed minutes are telling us. So we're going to go to Steve Leisman now. If you're on YouTube, you can see it. I'm just going to play it and listen to what he's saying, and we'll hear.
To the upside, inflation, they said, was unacceptably high and slowing less rapidly than expected. And an interesting comment here in the minutes, some saw the effects of higher rates on housing bottoming out. In other words, they had already gotten as much tightening as they're going to get, or easing in the housing market, and it was already had already bottomed out. We've seen that in some of the economic data. Some saw downside economic.
Okay, and if that's the case, that supports the whole housing market starting to pick back up, and which is why you have home builders building more homes. The supply is coming back online. Home builder sentiment is up. New home starts are up. They're all bottoming out because rates pretty much have peaked, right? Now that the Fed paused the rate hikes, and maybe they hike a little more, but either way, the actual 30-year mortgage rates have peaked out, and consumers have gotten a little more confident, and that would support the idea that we're at this turn, right? Yeah, rates are still elevated. They're still elevated, but we're at the end of the turn, which basically you're taking in consideration that the housing market, the pressure is leaving. And it's kind of like a beach ball. When you keep rates elevated, it's like pushing a beach ball underwater for the market. And once you pause, that's enough to let the pressure go, and the beach ball sort of shoots up. Now, when they actually start cutting rates at some point, probably not this year, then that's really going to start creating more demand for housing and other things, basically borrowing, and fuel the economy again. So anyways, they see the top of housing rates already put into the market start to roll back up. That's good.
Risk and upside risk to unemployment. So there is a dovish wing to the party there, to the FOMC.
What up, Ronnie?
GDP was seen as resilient, but expected to slow. And there's a couple more here. Consumer spending was stronger than expected. A few people were worried, though, in the committee that consumers are facing increasingly tighter budget constraints, including from less savings. The labor market was seen as very tight, but payrolls were expected to slow. Finally, tighter credit conditions from the banks were likely to weigh on economic activity. And in fact, the staff is still forecasting, that's the Fed staff, still forecasting a mild recession in the second half because of those.
See, and that's the reason why they're not going to, there's still more pressure for them to stay with the pause. And, even if they hike, they might have to reverse it, but to stick with the pause, there's more pressure because they're even anticipating the second half recession. Okay. They're not going to tighten into recession if inflation's coming down, and it is coming down. And yeah, economic conditions are starting to weigh lending, and everybody thinks it's so inflationary. I know we think, oh, it's so inflationary if Joe Biden keeps printing money, right? Fiscal policy, fiscal spending, or the Fed pumps liquidity into the markets. But as we know, lending rates, right? Bank lending is tight. So they're not lending as much as they would have in the past. And you can't get money into the economy. You can't cause inflation if you're not actually lending the money out to accelerate demand, right? We're not actually lending that out. So keep that in mind also.
Better credit conditions, but in general, they see the effects of as uncertain. And some even said, you know what? It ain't coming. Back to you guys.
All right, Steve, stick around as we welcome Daniel Morris to our conversation for more reaction on the Fed minutes and the impact on the markets. He is Chief Market Strategist at BNP Paribas Asset Management, joins us from London. You said you checked the accent at the customs, so we're glad to have you, Daniel. Welcome. Thanks. You say, among other things, that the Fed is more worried about avoiding a recession than getting inflation back to target quickly. What makes you feel that way?
Well, look at what they did at the last meeting. I mean, we know going into the meeting that they were not on target for their inflation projection for this year, let alone when we get back to 2%. So there's one or two ways you can react respond to that. Either you say, we're going to make that target, we're going to hike rates now, we're going to do what we said we do, or instead they say skip, pause, whatever you want to term it. And then in addition to that, they just raise the inflation target. So I think the signal to the market, despite what Powell may have said, despite what was even in the dot plot, is that they don't want to risk a recession. They do want that soft landing. And if that means inflation,
and do you think they'll get that? What is your base case assumption?
Yeah, I think the key point is you need to get GDP growth below trend, so 1.75% in the long run. But below 1.75 can be anywhere between 0 and 1.75, or clearly it can be negative.
And keep in mind right now, GDP, you want to get GDP below trend, 1.75. We're at 2% projected. So the economy is stronger than expected, which is the only reason people have excuses or even the narrative that the Fed can keep hiking because GDP is strong. But that's not actually a bad problem to have, right? It's not a bad problem to have that growth is better than expected. It's not falling apart. With all these rate hikes already into the system, yes, they're going to take effect in the second half, which is a good setup for the Fed to actually cut rates as we see inflation expectations continue to plummet. Now we got the S&P still teetering around the previous level. It hasn't really made a decision yet. Still more news to digest. We'll let this guy continue. Nick Timrose from the Wall Street Journal, FOMC minutes. The Fed staff still has Q4, has a Q4 23, Q1 24 recession as the baseline. So the Fed is still seeing a baseline recession for the second half. If that is the case, why would you think they're going to keep hiking? That doesn't make any sense, right? Of course it could happen, but for the most part, if the Fed is seeing a second half recession, then that gives us that gives us a forecast that they're not going to hike rates, right? They're probably not going to keep hiking. This might be the first pause. Also, I believe this is true. I could be wrong on this, but I believe, and of course I should know this, that the inflation numbers come out before the Fed makes their decision in the next meeting. And if that is the case and inflation comes in low, I think the market I think that's going to be a big serve, a big setup for the market to actually bid up, because you're seeing the expectation for the market is that they do hike another 25 basis points. Now, if they reverse that from the headline inflation that comes out next week, right? If that gets reversed, the market's going to blow, because obviously you're removing the expectation. And sorry, don't know who you are. You're removing the expectation of the hikes going higher because inflation is improving, and that is our number one issue. That is the big elephant in the room. Well, not the elephant in the room. That is the big dragon, is the inflation. No matter what, inflation is a real dragon, not growth falling apart, because the Fed can always pump growth if they needed to. Fiscal policy can pump growth if they needed to, but they can't control the actual inflation part or the supply side. Anyways, what else do we have here? The staff continue to judge uncertainty. The staff saw the possibility. So this is part of the FOMC minutes. We're still listening to those minutes. The staff saw the possibility of the economy continuing to grow slowly and avoiding a downturn as almost as likely as the mid-recession baseline. So they're really kind of going back and forth, right? Recession, we're going into recession, we're not going into recession. Which one is it? I think they are just playing with expectations here, because I mean, who knows what their motivation is? There goes the S&P dropping. So something must have came out new. The S&P is starting to plummet. We'll figure out what that is, but it sounds like they're teetering back and forth here. I don't know if there's any more minutes that we're missing. Not sure. Let's go to Nick Timrose. And they're basically saying we see a baseline recession in the second half, but a soft landing. So which one is it? Is it a soft landing, or is it a baseline recession? So that's the guy from Wall Street Journal interpreting those minutes. Remember, the minutes is a bunch of information. You want to read it all. You want to just get the highlights. Okay, here's what else we have. Some participants indicated that they favored raising the target range for the federal funds rate 25 basis points at this June meeting, which already passed. So they favor that didn't happen, or they could have supported such proposal. Why is that important? It just tells you there's some hawkish Fed members. I don't think it matters as much. S&P is selling off though right now to the downside. I don't know if it got triggered, if it was triggered by an algorithm, or if there's really some actually negative news in the pipeline. We will continue to monitor. These. Let's see these expectations. There's a lot of different news coming out. Let's see if there's something new that the Fed said. A few participants noted upward pressure on money markets. Treasury increased issuance might lead to lower. Okay, we already read that. Yeah. So I'm gonna have to reevaluate that and see exactly what they're trying to say there. But let's kick it back to this dude on CNBC and see what his take is. There's a lot of opinions on here on what the Fed minutes actually mean. It sounds like there's really no change. It really sounds like there's no change, and they're gonna leave it up to CPI next week. CPI next week, I believe, comes in lower. Maybe, especially for headline. Headline's going to be in the threes. We're at 4%. So we're going to be at the 3 percentile range. Remember, the Fed funds rate's at 5.25. So we're already in restrictive territory. So what happens as inflation decelerates while the Fed raises rates? Well, you tighten the economy, right? And I don't think they actually want to keep the economy tighter. If inflation is making progress, right? That's the key thing. Inflation is making progress.
So it doesn't have to be a recession. It just needs to be below trend. And we think that's the odds for us are higher than a recession.
And so the inverted yield curve is a signal, but not necessarily a definitive signal that a recession is coming.
It's absolutely a signal that growth is going to slow. That's very clear. And it's just historically, more often than not, you've ended up in the recession, but there's no, in a sense, inherent economic reason that has to be the case.
You heard Steve go through the bullet points.
You know what? And that's a key. I know a lot of you guys, or you've heard that the yield curve is negative. We're going to a deep recession. Well, the yield curve, in the past, the yield curve worked best when the Fed didn't speak. The Fed is front running or telegraphing all their moves now. So that yield curve doesn't work as good. What it does say is that we are either in or headed for a deeper slowdown in the economy, which is totally fine because the Fed, if inflation, it's all dependent on inflation. Like I said, if the CPI keeps decelerating to 2% by September or by second half, what you get is, okay, now the Fed can cut rates to some degree, maybe a small bit, or you keep getting fiscal stimulus into the economy to speed it back up or to accelerate it from the lows, or you get the Fed continuously pumping, buying more treasuries. So we can handle that. That this is a great bullish setup in the second half. The worst thing to happen would be inflation accelerates again, and I don't see that happening. Probably the biggest risk was this morning. The reason why yields are climbing so high because of that OPEC cut and the Russia. I don't know if that's even true. Russia agreeing to cut their production at the same time. Maybe they did agree on that. That should push oil higher, but we're not seeing that. We're not seeing oil get up. And if it can't get up, then inflation expectations are not going higher. So keep that in mind too. It's pretty simple, pretty clear that inflation will continue to decelerate, as we've said. I don't see anything in the pipeline to make that difference. And tomorrow we do have labor numbers coming in. We have the labor market report tomorrow and Friday, ADP private payrolls tomorrow. Friday, we get the real payrolls. We get average hourly earnings to see if there's any wage spiral, right? It hasn't been happening. Wage growth is falling. It is elevated. So people still have money to spend, but it is falling. It is not accelerating. So we don't have inflation pressures accelerating at all. Anyways, let's finish. I'm going to finish this. We're going to keep listening to this dude and then switch over. Not switch over. I'll stop it if there's more data that comes in about the Fed. Loving this story. Sorry, I missed the beginning. No, you're good. You're good, bro. Welcome to the live stream. Just trying to keep track of the Fed, interpret this complicated language that they use. They think we're stupid, but we're not stupid. No, I'm just kidding. I'm not going to play that political game. It is difficult, right? So I'm sacrificing my time to figure out how to deliver to you guys the best information I know. Hey, I could be wrong. Maybe if you have something you disagree with, let me know.
There on labor, on housing, and inflation still being unacceptably high. Yeah. How do you interpret what we learned from the Fed meetings with where they go from here about more hikes to come?
Yeah, well, I think I'm going to have to use a phrase that they've used, which is data dependent, but we need to put that in context because, the reason, frankly, we have all been so bad about predicting growth and about predicting inflation is because we are honestly in an unprecedented world. It's not just the pandemic, it's the global lockdowns, global reopenings, and trillions of dollars of stimulus. We've never had that before. So we don't have a model that can take that into account because it's all new. So hence, we've been lousy at forecasting. And we can have all the predictions and that we want to have, but it really is just going to see how does inflation evolve, what happens with the labor market, and the Fed is really going to have to react to that.
Steve, let me bring you back into the conversation and ask whether there's anything in these minutes that we didn't know already.
Right.
No, but I might give you the experience of reading.
Yeah, I don't think we'll come back to him. Zero Hedge from Twitter, big dude, has a lot of information. He also has a take on it. We're going to go through everybody's take on these Fed minutes to see has anything actually changed, or are we still on the same rate hike? But the big thing here is if the Fed pauses if they're leaning towards a pause and holding that pause, as we've seen. By the way, the Fed has never paused rate hikes, never in history. They've never paused and started hiking again the next meeting. It never happened. So this would be 99.9% unprecedented. Okay. And that is, so I think they're just playing with expectations here. Either way, that I just want you guys to know that information, keep that in. So much more with you than how they put it. Yeah, it's very confusing. I mean, because they're talking to other people who understand the market, and I didn't understand the market for a long time, so I'm trying to learn as much as I can, spit it out in simple terms. So here we got zero hedge. This was 21 minutes ago. We might have already heard this, but let's see his take. He makes it simple. Almost all officials expected more rate increases in 2023. Okay, so they expected it, but things changed. Why? Because inflation is coming down faster than expected, not core, because shelter is still falling, and we all know that. Jerome Powell has already expressed that shelter prices will price in lower, taking down the core. All right, some favored hike, but went along with the pause. Duh, of course, because how are you going to growth continues to decelerate, right? On GDP, labor growth, every piece of growth is decelerating. Manufacturing, services is even falling, even though it's still above trend. And the housing market, labor market, all of it is falling. As much as you hear the labor market is strong and it continues, labor market continues to be strong. As much as you hear that, yes, it's holding on, but it's decelerating. It's not accelerating. The labor market is not accelerating. Keep that in mind. It is falling month over month, but it's still above zero. It is still above zero. As long as it's above zero, we're still expanding. So it's a soft landing, right? We're not a hard landing is everything collapses. We're under zero. We're beneath negative. And if you want to note that, what I mean by negative or below zero, we're going to go over those charts. We're going to go over those charts, or just subscribe to the newsletter. It's a free newsletter, macro newsletter. Have all the charts in there that highlight and explain what we're talking about here. If you want to do that too, check that out. Link in the description, usually, or bio if you're on TikTok. All right. So what else do we have here? Fed almost all saw pause as appropriate or acceptable. Good. Yeah, that's what we want to see. Oh, he used ChatGPT to summarize it. Nice. Do I want to click on this? That's pretty cool. You got to use ChatGPT. This is the best way to use ChatGPT to summarize the notes. Discuss the current economic conditions and note that the economic recovery from the pandemic continue to strengthen. Okay, great. We're still strengthening. They recognize that the increase in inflationary pressures and debated whether those pressures were transitory or more persistent, with varying views among the members. Okay, here's what that means basically. Is the inflation transitory that we're seeing right now? Is it transitory or is it sticky? It's starting to look like it is more transitory because demand is slowing. Okay, demand is slowing. It is not speeding up. It is slowing. And people say, oh, well, there's still so much money in the system. Yes, but supply chains are back online. People are producing more products. The more you produce, the lower you create your prices, right? If there is no production, if you have less supply, you have to hike your prices in order to meet your revenue, or in order to meet your income. You have to increase the prices because you have less of whatever that item is or whatever that service is. But now that we have more people coming into the workforce, unemployment is low, then you have more supply online, right? You have more production. Therefore, the supply chain issues, supply side inflation is being solved. And plus other global entities are also, China, Japan, they're all back online. Supply chains are working. So that solves a lot of the demand. That basically makes it a nothing burger. And therefore, it is transitory. It is going to be transitory unless demand starts spiking for some reason. It's going to be transitory, right? And which part of it is really sticky? It would be sticky. Let's put it this way. UPS. I know you guys heard about UPS today. Let's say UPS, they are a big part of the supply chain in the US. If UPS stopped their, they're supposed to start strike July 1st, right? If they start striking and they don't run their supply chains, if they don't deliver, that's going to be issue. That'll be inflationary, extremely inflationary. I really doubt it happens, but what it does is it stops the supply. So you make all these orders, they can't come to you. They're not going to get to you. You get upset, whatever. You have to find other people to deliver these orders. They're going to do it at a higher price. Therefore, inflation starts to rise up again. But I really doubt that even happens. So that's supply side inflation. Demand is not going higher, right? Demand side inflation is not picking up. Because bank lending is tight. We already know that, right? Banks are pulling back on their lending. Therefore, you're not going to get that demand side inflation. When banks actually start lending more and rates fall, then you can think about that type of pressure. But by the time that happens, inflation will be back at 2%, and you'll be able to use AI to increase your productivity. Therefore, inflation never really picks back up. And a lot of people think, oh, if there's more money in the system, inflation goes higher. Then why haven't we had inflation for the last 50 years? Because we've had supply chains working, we've had good productivity. That's what got hurt for us to see this. It was the extreme, not just the extreme demand, it was the fall in it was the extreme reduction of supply, of the lack of productivity, that really kept inflation from being transitory. That was the real issue there. The FOMC members discussed the ongoing asset purchase program and the pace of tapering those purchases, with different opinions on the appropriate timing and approach. Oh, interesting. So now they're talking about the Fed's balance sheet, right? We already went over the Fed's balance sheet plenty of times, which basically is, will the Fed keep shaving off their balance sheet? And that's AKA, will the Fed keep removing liquidity, removing cash from the system, i.e., selling treasuries back onto the market? So if they sell something, they're pulling cash out, right? Because they're selling it for cash, right? Now, if they start buying back treasuries, which we want to see for QE, if they buy back treasuries, they're basically injecting cash to take treasuries off the market. Okay. And that would also lower rates. So that's going to be the big shift, is once the Fed starts repurchasing treasuries and pushing liquidity back in, which I think they're going to do it no matter what. You pull down rates in the bond market and you increase cash back into the system. And now they are actually disagreeing. Before they were completely, oh, let's stay on QT. They're not in QT right now. We're getting the cycle starting to turn into QE, right? Because it's not going from QT to QT. It's going from QT to QE. It might take 3 months, but the turn is starting to happen, and it all depends on inflation pressures. There was a consensus among all members that any changes to the asset purchasing program should be based on careful evaluation of incoming economic data, i.e., inflation, right? I.e., labor market. So that's why we track the data every day, because they're really data dependent. If they see a spike in the data, then we can assume that they might keep hiking rates, or they're going to be more likely to keep rates higher for longer. But that's not the case. All the data is pointing to a deceleration year over year. Now, month over month, right, when it comes to GDP, or actually GDP, when it comes to GDP, we're still decelerating. It's just coming in better than expected, which is a Goldilocks scenario. Because if you're expecting lower growth and it comes out higher, well, the market's excited. Oh, we're not going to a deep recession, but that growth is still on a quarter over quarter basis. It's still falling. So it doesn't mean inflation, right? So you're getting better than expected, but still slowing. That's perfect. That is Goldilocks for now. That could change. The members discussed the labor market and noted that significant improvements in employment levels, but also highlighted the need for further progress. Okay, further progress. Well, whatever. I mean, we'll see. We will see. Once we get to 4% unemployment, if we get there, we could get there. We still have a whole 6 months to go, 4 months to go. If we get to 4%, they pause. Or not, they pause. They cut rates, in my view, if we get above 4%. They recognize the challenges faced by certain sectors in hiring and potential impact on labor supply constraints on economic growth. Okay, so some parts of the economy are weak and some parts of the economy are still expanding, and that is true. That's why this is actually a perfect scenario, like I said, because if you have weakness in the goods and manufacturing sector, you don't get inflation. Inflation doesn't rise. It actually decelerates, but you still have services, right, which is most of the economy, still strong, which keeps growth from collapsing. To put it in simple terms, you have a rolling recession or a rolling expansion, i.e., some parts are slow, some parts are strong, so we're neutral, which is perfect because inflation doesn't rise and growth doesn't collapse. It's like a perfect medium, right? We need that perfect medium until inflation abates enough for the Fed to start cutting rates, or the bond market to slow down a little bit and the bond yields to come down a little bit. The FOMC members also discussed financial stability risk, including elevated asset valuations and leverage in some sectors, but concluded that the overall risks were moderate. Well, you know what? Jerome Powell came off and said, we don't care if the stock market goes higher. He said this in that last meeting with Christine Lagarde and the Japanese, I don't know his name, Fukushimoto. I'm just kidding. Something like that. Either way, he said, hey, we're not worried about the stock market going higher. In fact, I'd argue it's even better for AI to take over, for the AI narrative to invest capital into the AI narrative. Because what does the AI narrative do, or what does AI actually do? It actually reduces inflation, because at a tenth of a cost, okay, less costs, inflation comes down, more productivity, you produce more GDP. That's the idea of AI. If you execute it right, you're increasing productivity 10x at a tenth of a cost. Is it perfect? No, not all the time. But anyways, that is the idea. I'm gonna get your guys' comments. I just want to get through this Chat GBT. See, this is part of the deflation, right? You use Chat GPT to increase your productivity here. The committee reaffirmed its commitment. This is the last one, commitment to achieving its dual mandate of maximum employment and price stability. Now, keep that in mind. They still want maximum employment, which means, that's why I say if they get to 4% unemployment, then they're missing. If it gets above 4% now, and that's an arbitrary number, it could be 3.9, it could be 4.1, but they're not achieving their mandate. So don't assume they need unemployment to spike. They don't want that. They want prices to come down, right? And keep employment strong. So employment being strong is not a reason to employment being strong is not a reason to hike rates. What a reason to hike rates is that wage inflation picks up. Okay, wage inflation picks up, but we're not seeing that. And we'll get more numbers on Friday. We'll be on this on Friday, while maintaining a patient and flexible approach to monetary policy. Exactly. And that's the thing. The Fed does not want employment to tick lower, or to fall off a cliff. They want price stability. It's just usually you destroy employment to get prices down. But at this point, we're not seeing that. We're actually seeing employment stick up there pretty, it's keeping up, and price stability is actually leveling out. And I know you core people, well, core is still bad. Somebody mentioned that, and I'll get your comment. They're most likely interested in core numbers. Yes, they are, Mike Duns. And the problem with most, I don't want to say most people, but most outlooks, is that core, 40% of core, 30 to 40% of core shelter. It is shelter. And if you look around the country, especially where I am in Arizona, shelter prices are coming down. You've heard it 1,000 times. Zillow rents, Redfin data, Case-Shiller, which is metropolitan rent inflation, and housing prices, inflation in general, they're all collapsing. And the data the Fed uses is very laggy by 8 to 12 months, which means it's eventually going to come down. Why? And Powell acknowledged that in the last meeting. He acknowledged that shelter will eventually come in lower. I'm being optimistic. I'm a little more biased, obviously, because I want to see inflation come down, but it's been 12 months. It's been longer than 12 months. And I think most people, they move during the summertime. Maybe I'm wrong, right? Call me out. They move during the summertime. And the reason why it's sticky is because if you sign a lease in the summer, April, May, June, July, whatever it is, you sign a lease in the summer, your prices aren't coming down for the next 12 months. Most leases are 12 months. So I think we're hitting that, the end of the summer. As we hit the end of the summer, we're going to see the leases start to reset. So if you're new, then you're going to see those leases reset. And reset lower. They're going to come in lower. We're seeing it. We're already seeing that. So rent comes down. Maybe I'm wrong. Maybe I'm 100% wrong. But that is the idea. We're tracking it, and the data tells us that. Next part on here is FOMC minutes. Almost all Fed members see more rate hikes in 2023, and they're saying in 2023. They're not even saying July, August. They're not even calling for that. They're just saying at the end of this year, maybe they hike rates again. I think they're just pushing it down the road. Their hawkishness down the road to keep excitement from expanding too much. So what do we got here? We got I think regardless of one or two possible rate hikes, NASDAQ and Dow won't plummet enough to change the trend to bearish at all. Higher time frame. Yeah, even if they hike, we possibly see the NASDAQ. I'll stick with the S&P. We see the S&P maybe come back down to 4,200, which was that breakout level, if they hike 2 more times. Now, it's all about the speed. If they hike 2 more times right away, boom, boom, yes, we come down. But if they hike once and they wait 2 months and then hike again, like I said before, that's never happened in history. If they do that, the market can take it in stride, especially if inflation is falling. Again, there's no way they keep hiking. Okay, there's no way they keep hiking if inflation keeps falling at the rate it is, headline inflation. And we'll figure that out. Hopefully those oil prices stay tame, right? Hopefully they stay tame. If the oil prices get out of hand, then yes, I see the market pulling back a little more. Anyways, Almost all participants noted that the economic projections. Okay, I might be repeating myself here. I'm just making sure I'm getting all the info that was coming in. Observed uncertainty about the outlook, considering the appropriate stance for monetary policy. It's a bunch of blah blah blah. It's really blah blah blah. That's all I'm seeing here. Oh, here's a new one. Here's a new one. Is this a thread? 27. Yeah, let's start with this one. Let's start with this one. Almost all participants judged it appropriate or acceptable to maintain the target range for the federal funds rate at 5 to 5.25. Okay, so target we're talking about now. Why does this sound so contradicting? Am I missing something here? So almost all participants see it appropriate to keep the pause, basically 5 and 5.25. That's where we're at right now at this meeting. Most of these participants observed. Oh, okay, that was the last meeting. This is the Fed minutes from the last meeting. Okay, cool. Most of these participants observed that leaving the target range unchanged at this meeting would allow them more time to assess the economic progress toward the committee's goals of maximum employment and price stability. So what's happened since then? Well, the leading indicators, the PMIs, after that meeting have came in weaker, right? We talked about this yesterday. Manufacturing came in weaker. So what does that tell you? That tells you that the data is weakening, right? We're seeing weakening data. So duh. I mean, I don't want to say duh, but it's like, hey, the data is weak. So why would they keep hiking? Okay. And guess what? If you're worried about the stock market, the market's already priced in another hike. So if they don't hike, it's going higher, right? If they don't hike, I mean, that's more beach ball going higher. Either way, but these are the FOMC minutes. Blah 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 blah. What else? What do we got here? Inflation still well above committee's longer run target. Sure, whatever. High inflation might cause inflation to become more anchored. What is something new? I want to hear what is there something new that we don't know yet? And we're going to turn back to this video to see if Steve Leisman has anything new. AMD is starting to bounce on that trend. Okay, this is not part of the FOMC minutes, but I am long calls on AMD January 2021, and I'm looking to add here as we pull into the trend. It's looking good. Not a financial advice at all, but just to keep you updated on what I'm trying to do. Thank you, Dimaj. Man, I need my Stream Deck so I can actually like hit the buttons while we're going here. But yeah, thanks, Dimaj. I appreciate it. I'm glad that I'm giving you guys some good info here. I hope I can keep it up and, quote me if I'm wrong. Guys, call me out. If I'm wrong about something or you disagree, don't be afraid to let me know for sure. Summarizing an article using ChatGPT can do it. I'm designing CPUs. Oh, dang. Okay. I see you out there, football legends. It's now incredible. Much more exactly. You don't need as many people. The ChatGPT or AI in general, right? ChatGPT is an example of that. You basically can shave off a lot of workers that you're paying for payrolls. So a lot of your margins increase for the stock market, for equities, for companies, their margins can increase as ChatGPT takes over a lot of the jobs that were priorly needed. Yes, I am live on TikTok. Are we missing something here? I'm pretty live on TikTok. Yeah, we're live on TikTok, right? Yes, I might. Oh, that got me confused. Article. Yeah, we are live on TikTok. I'm in AMD long 2. You're saying add. I'm adding because, well, the reason I'm adding isn't in general. I'm adding because it's pulling into my trend. I can pull it up after this, but it is pulling into my trend. And I got in early around, and I'm looking at, I think I'm at 115 calls. I'm looking at 115 calls. And I'm already up on it. So I have a cushion, right? I'm not buying here. I have a cushion. And my expectation is that these numbers come in stronger than expected. They did get an upgrade today too. So they got an upgrade and they sold off, which is perfect. I want to see that. Upgrade, sell off, make new lows, get back to the prior 2 days. We just filled the gap at 113.90 on AMD. And so I'm expecting AMD to gap up tomorrow. Maybe I'm wrong, but the S&P is pounding at the top of the door, at the top of the level. All right, let's get back to these FOMC minutes and to complete the
them, Tyler. I don't know if you've ever covered the courts or something like that, where you read a decision by the judge and it reads as if they're going to find him guilty, and then at the very end they find him not guilty. Mm-hmm. These minutes read like the minutes of a committee that was about to hike rates. Labor market's too tight. Inflation, no clear signs coming down. all of it amounted to or seemed to amount to the case for hiking. And yet at the end of the day, they decide to wait. I was hoping for some clarity on why they were waiting. I think Daniel has an interesting thesis here. I'm not sure I 100% buy it, but it's a good thesis that they're more worried about recession than perhaps.
They are more worried about recession. They're not gonna sacrifice the market. Everybody thinks the Fed wants the economy to collapse. That is not true at all. Why would the powers that be, if you hold the narrative, if you're conspiracy theorist, everybody's a little bit of conspiracy theorist, but if you believe the Fed wants to crash the economy to make the rich rich, what are you talking about? The rich make money off the economy in the stock market. Why would they want to crash? They don't want to crash. They want to save it because that's where all their net worth is in. They don't want it to crash. So yeah, that's kind of, it just doesn't align. It doesn't make any sense. What about Tesla? Do you suggest shares or options for Tesla? I'll get into Tesla. We'll go into some trades after this, because yeah, that's a good question. AMD and Tesla. I'm looking at AMD and Tesla right now. Tesla today, I wouldn't worry about it. Just to give you, like, if you're looking at Tesla right now, let me pull up Tesla in the side window really quick. Mr. Football Legends, it's consolidating. I think I don't want you to I personally wouldn't chase Tesla right here. I wouldn't chase it. I want to see this wedge. It's forming a wedge. I want to see it consolidate for about 2 or 3 more days. Okay, I want to see it consolidate for 2 or 3 days. I think it keeps trying to push the 283, 284 level and then comes right back down. The best entry would be it collapses and then it catches a bid and goes up. It's a very technical term, but if we get below 275 and then capitulate, that's usually when Tesla starts to run. You basically come down, you grab liquidity, and you explode right back up. And the narrative is taking over. But again, I always say you want confirmation from the overall market. So you want to see the cues also showing some strength, and Tesla's going to lift if we do get that. We got earnings coming out. Production numbers did very good. So what does that tell you? Revenues are going to come in strong. So yeah, that's it. Anyways, let's finish up here on the minutes.
They're letting on, but I do think they are going to hike in July. I think the groundwork has been laid for that hike, and I also think it's entirely possible they're going to move on to hike again in the next after one more skip. I think they're in this pattern here of every other meeting. They want to get the rate back up. I don't see, by the way, much change at all in the probabilities for November is the meeting we're looking at. It's still about a 35%, 36% chance of a hike, and there's still a strong, 85, a little bit higher now, percent probability of a hike in July. So I do think they are going to hike in July. I think they're going to hike again, maybe later this year if they don't get a big change in the inflation and in the jobs numbers.
So that being said, if there are more hikes to come, where do you see opportunities? Do you still think that there's room in market equities, or do you think that investors need to look elsewhere?
Well, I guess thinking of other asset classes or geographies, I mean, certainly we're cautious on the outlook for the U.S. and for Europe. And in the U.S., certainly it's with the strong returns we know we've had this year in particular. So we say unbalanced returns, so dependent on tech. We don't feel comfortable with that. So actually we are underweight U.S. equities and looking to emerging
Okay,
markets
whatever,
instead,
bro.
Because
all right, so story, tail of the tape. Nothing has really changed. We're going to be looking out for inflation numbers. That's going to be the biggest deciding factor. How does inflation come in next week? So I am going to switch this. If you're on YouTube, I'm going to switch this up and we're going to look at the economic data. We don't need to hear that anymore. They're not really saying much. If they do, if I see something else, I will pick it up. So let's look at this economic data. Is that even zoomed in enough? Let me see if I can make this bigger. There we go. So let's look at this economic data we have coming up here to keep you informed as best as possible. I got EU, I got China, we got all the data. So here was Tuesday. Okay, let's jump back to Tuesday. We got no, this is next month. Sorry. See, this is why I need my button when I mess up. It's just funny. Oh, okay, yeah. If I mess up, stupid. Oh, it's on a loop. Stupid. Okay, there we go. Just had to put it in there. I got to be quicker with that. I got to get the stream deck working, so that's actually a little more on time, or else it's too cheesy. ISM PMI numbers. So if you on YouTube, you can see the ISM PMI numbers for this month. That was I guess that's for next month again. All right, so going back to Monday, this is just so you could get an analysis, or you could think about what is all the context that we're starting to see, right? is the Fed going to hike? What do I do? Just to supplement your trade or your investing ideas. This is why we're doing this. So you can supplement that. So you understand with the macro, where it is leading. Okay. And what we see here on Monday in the US, ISM PMI dropped from 46.9 to 46. Below 50 is recession territory. Below 48, there's always a recession. I'd argue we're already in a recession, just not in all segments of the economy. A rolling recession is what they call it. So if they are data dependent, well, guess what? The data shows we're still decelerating. Why are they going to hike rates? Can they do it? Sure. But it's very likely that this data, if they're data dependent, shows that they hold, that they pause. Okay. I think the pause is on. I could be wrong, but I think the pause is on. Okay, let's go to employment. Look at from 51 to 48. Employment is now contracting in the ISM manufacturing sector, which is the leading business cycle, leading indicators for the business cycle. So employment is falling. Construction spending is up. So that's good for growth. That's not necessarily inflationary because you're building productivity. If you build, you're building, you're keeping jobs and you're producing more GDP. That's good. That's not negative. ISM manufacturing prices. This was key. ISM prices here fell. Right. That is the wage. You hear wage price spiral. Those are actually falling. Wage price spiral is not happening, especially not in the manufacturing sector. So prices are down while new orders, ISM new orders are up. And basically, what this is people are still ordering, so there's stuff happening, and I think those new orders are going up because of the construction spending, because of it all stems back to fiscal policy, right? CHIPS Act, Inflation Reduction Act, infrastructure bill. Those are all bids into the economy going over time, which is why I don't see a full-on deep recession, because the government is spending in the economy to build manufacturing, right? So we are in a manufacturing recession, but don't expect it to go deeper while we are literally bidding on growth in that area while prices are falling. That's perfect because you get no inflation there. All right, so let's move to Wednesday because we had nothing yesterday. We just had Chinese PMIs. How did those come out? Look at the Chinese PMIs fell. So China's leading economic indicators are falling. They're still above 50, so they're still expanding, but they are falling. And what does that tell you? More cowbell, more that they're going to have to unleash stimulus at some point. Japan's PMIs for services also declined. This is a perfect setup for the macro because they have no inflation. China has no inflation. So if they're not growing fast enough, they're going to sprint. They're going to stimulate their economy. Their loan growth is up. Everything else is up. More stimulus for China, more stimulus for Japan. That's going to leak into risk assets. We're going higher from here as long as inflation remains tame. Okay, now here we go to today. What are we getting in the FOMC minutes from last month? By the way, this is not today. This is from last month. What did they change? Nothing really. Nothing really changed. It's really a nothing burger, but we have to come here and figure out, is there anything that has changed? We do have Fed Williams speaking at 1 p.m. my time, which is 4 p.m. Eastern time. So that's not going to be for a while. We could discuss this tomorrow if he says anything significant. Moving on till tomorrow. Tomorrow we have challenger job cuts early in the morning. What is this, 5 a.m.? This just shows you how many this is 4:30 a.m. This is 7:30 a.m. Eastern time. This tells you how many companies, or if you take all the cuts, right, the job cuts, are they climbing? Are we seeing more job cuts or less? If it stays where it's at, great. If it explodes, then we can expect unemployment to go up because more jobs are being cut. And that puts more pressure on the Fed to pause. Okay. Now, is that bad for the economy? No, because guess what? There's more jobs. The job openings are still pretty elevated, which means, and we're going to get that data tomorrow, job openings are still abundant. There's still an abundance of jobs, right? So if you're just sitting on your couch and you want the perfect job, sure, you're not going to get one, but there is enough jobs out there and just nobody wants to do the hard labor jobs, right? Which is why eventually Tesla's going to take over with their robots, blah, blah, blah. Not kidding. Challenger. Okay. And then we got private payrolls, employment tomorrow. And that's going to give us some insight into how payrolls on Friday come in. Those are private payrolls. So government payroll, I think those remain strong because the government keeps spending on themselves. So the government spending is actually keeping the economy strong and it's not inflationary. Jobs have been holding well. Yes, jobs are holding well. Jonathan, what up, Jonathan? Yeah, I see you, Hassan Jamali. I see you, Football Legends. Yes, I appreciate it. I'm glad that Tesla post. I worked pretty hard on it yesterday. It's basically that Tesla post, Football Legends. If you guys didn't see it, go check out the TikTok. I also put it in a YouTube video, so it's also a YouTube video, and I'll show you guys what that YouTube videos if you want to see it. And it's basically showing all the catalysts for Tesla and how they're progressing. I think we go to all-time highs this year for Tesla. All right, next. We get the service. Oh, this is key. We get services PMI tomorrow. Okay. So we had remember, there's two parts of the economy. The economy is constructed of services and manufacturing, just as a general term. Okay. We're seeing manufacturing decline while services are not decline. Services are expanding. Now, services are at risk for actually going into recession territory. So that is a risk, which is why, again, the Fed is not going to keep hiking while services go in decline. Okay. That is the leading economic data here. So we get services tomorrow. We're going to see if the price is paid in services, which is the supply side inflation, if that climbs or if it stays where it is or if it falls. And point being here, overall, to simplify it, are we in a rolling recession? Are services holding up the economy? Is manufacturing pulling down inflation? I think so. Job openings, we get that tomorrow. So we get to see, which I think really doesn't matter. Like it's whatever. We're still elevated. People get jobs. So this thing slowly trends lower is perfect. It's perfect because you want it to be elevated because people, if they do lose their job, they can go find another job. Okay. This is in general. This is not the exception. Okay. If you want to go find an exception, you can find exceptions anywhere in society, but we do not make rules or choices off the exception. If you're jumping out of a plane and your life-saving bag, what I can't even think, your parachute had a 10% chance of deploying, you're not going to run off the exception. You're going to run off the rule. So the rule is if there's more jobs, people can move to another job. Okay. And that's positive for the economy. And if it comes down, it closes the gap for wage inflation. That's also positive. So this is just a positive. Maybe I'm too biased here, but either way, the setup looks really good. I'm seeing the big setup. We'll go over the biggest risks to the market. Those will come up too. So that's what we got tomorrow coming in, hitting the tape. What else do we got? Total vehicle sales. Vehicle sales as a good have actually been pretty strong. And that could be accelerate. That could keep manufacturing from collapsing because there's demand for vehicles, right? Tesla vehicles, also best-selling car in the world. Model Y. Friday, unemployment rate. This is big. Unemployment rate Friday. Non-farm payrolls. That's the big number. Look at these payrolls. The payrolls have been accelerating, right? Actually, I was wrong. I thought payrolls were decelerating. They're actually accelerating. So that's good. This could, if these things continue to accelerate, I mean, let me make sure this is visible. Let me go to the 1 year and go to the columns. There we go. So if this continues to accelerate, it could push inflation expectations up. But employment isn't necessarily inflationary. I think people have it wrong. The more people employed, the more productivity, the more supply, the less inflation. The more the supply swallows prices. You don't increase prices when you have a lot of a product. You decrease prices. Get out of my way. Right? So that's not necessarily bad. I don't know. I think people have it wrong. What causes supply side inflation is going to be average hourly earnings going up. This will be bad. If this thing spikes, then the Fed, that's wage inflation. That is a precursor to wage inflation. So that's where we need that to stay down. Labor participation, if that goes up, that's good because you get more supply, more production. Always think of that. The more supply, the more it swallows the demand. If you have no supply and high demand, that's where inflation goes up. All right. So that's what we got, man. That is in the pipeline for the rest of this week. And again, I'm just giving you some insight in tomorrow. I'll still be live tomorrow. So by the time I get on live tomorrow, if you want to catch it, I'll be on the ISM PMI will come in. I'll be on live tomorrow, 10 a.m. Eastern time. And I'll be on TikTok and I'll be on YouTube. I appreciate you guys. Come get me. If you guys have not subscribed to my YouTube channel, check it out. Give me some subscribers. Help me out so I can get my channel up. I'd appreciate it. Either way, yeah, I'll see you guys there. Anyway, I'm not getting off yet. I'm just trying to think of what. Oh, okay, there we go. Yeah, so that's what we got in the pipeline tomorrow. ISM services, jolts, a lot of good data tomorrow. A lot of good data. And we're gonna see how the market responds to that. Right now, actually, I can pull up. let's see what how the Fed is actually, or not the Fed, how the market is actually responding to this. So this is the Fed's preferred inflation gate. I'm sorry, this is the market's anticipation of what the Fed's going to do, and what we're seeing is an 87% chance. So this is July 26th. Why? I was so confused because on the calendar, July 26th, right? And I'm going to do this live. July 26th. This is this month. Why? Where is the Fed meeting? There it is. Fed meeting. Okay, so the Fed meeting is July 26th. So this is perfect because we can anticipate what the Fed's going to do. Why can we do that? Because we're going to see the data come in. And this is good because you get the inflation data before the Fed acts, right? Which means it's easier to, I don't want to say predict, but if inflation comes in like very low, then, which is going to be next week, then we anticipate that the Fed is more likely to pause. And what that means is this rate hike that is anticipated to come into the market could literally be nothing. It could just go to zero and they can pause over here. If this is where you really get upside, or I don't want to say upside. This is where you really get volatility to the upside because the market's expecting a rate hike. What happens when they pause, right? If they pause, well, that's going to be extremely bullish. And it all depends on the data coming in. All right. So we had what do we say? AMD. We'll check out the AMD now. Let me double check and make sure that we're not missing any more. Oh, look at this Tesla auto trade. Summer sales heat up. Hey, we're just talking about Tesla. Let's listen to what they have to say about Tesla. Okay, we'll do that. But hold on. The guy who was looking for, what was it? Jonathan says, Judas, also issue has been all-time credit card debt. Well, Jonathan, I look at it this way. I get the credit card debt all-time high, but unfortunately, we live in a fiat system where debt just goes higher every single time. So debt will always go higher. Debt is always going to climb. It'll slow down, then it'll climb, then it'll slow down. So really, it's kind of a false narrative, not for you, but it's a false narrative for people to say, oh my God, look at the all-time high debt. Well, guess what? It's already priced in. The market already knows that debt has been climbing. And if it becomes a risk if people lose their jobs. That's where the risk lies, Jonathan, is when people lose their jobs, because then they can't pay their debt and the debt never gets rolled. The debt actually becomes a collapse in growth completely. People start defaulting. So do you see the trend? All-time high credit card debt for people. Well, guess what? All-time high credit card debt, not credit card debt, all-time high debt for the US, all-time high debt for Japan, all-time high debt for a bunch of countries. Debt keeps going up because they print to fuel growth. That is the conundrum we're in. That's why technology is going to outperform over the next 10 years, because technology is the only thing that they can actually invest in where it creates more productivity to pay off the debt. We can never grow GDP to pay off the debt. We can't do it because we have too much debt. So the only way to do it is Chat GPT, not exactly Chat GPT, but AI. That's why AI is going to be very huge, because that's the only way to pay off the debt. So yeah, credit card debt's bad. It's climbing up, but that's a secular trend. It's not it's not like it just came out of nowhere, right? It's been going up. Same thing with the student loan repayment program. Well, that's already priced in. Everybody knows it. The market's not going to react negative to something that's already known into the market. It's going to react negative to something that is a surprise. So what you really want to look at is delinquencies. Are delinquencies picking up? Because if delinquencies start spiking at an all-time high or at a rapid rate, then growth is about to collapse. But even if growth collapses, what do you think is going to happen? We're going to see Mr. Joe Biden come in. He needs to get reelected. Well, all you guys that need more stimulus, that need to pay off your credit cards, you're misinfortuned and you were screwed by the system. So this is a relief program. So either way, I think we get more stimulus. And this is not political. I'm just saying in general, that's what politicians do. They print stimulus to get more votes. So even if credit card debt starts turning into delinquencies, expect him to spend more. Doesn't mean it's going to happen, but usually that's the case to save the economy. And just alone, credit card debt isn't going to crash the economy. You got growth coming into the system, right? You got growth coming into the system. So we'll see how that turns out, Jonathan. But yeah, thanks for the comment. That is a risk, though. You got to keep that risk up there. Defaults, I think, is the bigger risk. Delinquencies, vehicle delinquencies, blah blah blah. When mortgage delinquencies pick up, that's the that's the real issue right there. Anyways, yeah. So AMD, here we are. We're looking at Bitcoin. Let's jump to AMD. Let's jump to AMD for the person who said why AMD. Also, I like MSTR, but let's look at AMD really quick. So, really quick, AMD. Oh, where'd it go? Oh, there we go. Okay. So AMD is climbing, right? We've been moving up in AMD. We pulled back in AMD. Now we are starting to break the downtrend, right? This was secular, so this is big. Now we're in an uptrend. So let's kind of come in here a little bit and let's zone in a little bit because that was a lot of data. This was October. This was the low in the market. We've been moving higher for a while now. So my bet is once we get over all-time highs, there's nothing but air for AMD. It's going to get squeezed. So you're looking for a big pullback in a support. Let's go into the daily chart. You're looking for a big pullback. Well, I think we just got that pullback. Look, AMD just pulled back. It actually dropped support, and it's pulling into the trend. Actually, there was no trend. What it's doing is it now that it did find support at the gap fill 108 level. This was the gap fill at 108. It filled that gap and it formed some support there, and it moved up. I got in at 111 because that was the break of my previous zone. Okay, for you non-traders, just stick in there, right? But if you are a swing trader, I'm just trying to explain how I'm positioned in this. So I got in here. Now we retested the previous support, getting rejected. That's a bearish signal, but we're still in the uptrend for AMD. So I have a cushion. If I get stopped out, I get stopped out. But this is my cushion that I'm seeing, right? We're holding this uptrend at the moment. I want to remove from here I want to remove the pre-market extended hours and just look at the trend by itself. There we go. That's better, right? So we're in this uptrend. It's holding pretty good. And maybe it needs more time. Maybe it needs to come back into 111. Okay, that might be a better trade. But my support right here at 114, that's where I'm seeing. And look, it looks like we're bouncing at 114. Looks like we're bouncing. And there's no perfect entry, but it looks like it's bouncing. And I want to buy that support, right? I want to buy that support. If we decline, guess what? I have a cushion here. I have a cushion. So that's how I'm looking at AMD. For Tesla, somebody mentioned Tesla. Slow burning issue I'm watching is the commercial property and property loans. Good points on credit cards. Yeah, commercial loans are also falling, and our commercial loans. The thing about commercial loans, they don't roll off. They have so much time to roll off, meaning that it won't even be. They'll keep rolling the debt until later. So I don't even think the commercial real estate. Maybe I'm wrong. This is just my research. What I've seen, that commercial real estate won't become a real systemic issue until later down the road. And at the end of the day, it's just going to go right into the Fed's balance sheet, right? Because really, who's connected to that? Banks, regional banks connected to that. What happened last time regional banks had an issue with deposits? The Fed stepped in with the bank term funding program. So maybe next time we have the bank term real estate program, right? At the end of the day, they're going to create a way to create to maintain banking stability, because they're not trying to crash the market, right? If me and you can see these risks, guess what? The market has already seen the risk. The Fed's already looking at them. So I don't really see that as a risk. I see black swan as the risk. And you got to weigh that against inflation. As inflation decelerates, that's a bigger gun, right? That's a bigger inflation decelerating is the heaviest weight to push the market up, right? Not commercial real estate. If commercial real estate falls apart and the Fed steps in, great. If inflation falls apart, the Fed doesn't even need to step in or do anything. If inflation falls apart, the market goes higher regardless, right? So anyways, here's Tesla. Look at big wedge. We got this nice, beautiful wedge forming. So here's what I would say. If we get the Qs breaking out, keep your eye on that wedge. If we get the Qs breaking above this zone, okay, what is this, 372? And we could get this over the next couple of days. Like I said, we have employment tomorrow. We have services PMIs. And then we have Friday, we have the strong employment data. So If the Qs get above this level and support, so you see something like this, jump over to YouTube if you can't see, right? If you get the Qs break out, retest, support, and go higher, and maybe it's going to be somewhere in this breakout to hold where you want to see Tesla hold. If the Qs can't break out, I don't think Tesla breaks out, right? But if the Qs break out, expect this giant wedge to start breaking and holding, but know where your stop is, right? Maybe under 280, because 280's been support after. That's kind of like the breakout of the wedge. But look at that beautiful wedge there on Tesla. Beautiful wedge. I love Tesla patterns because they're just so beautiful, right? They're easy to see, unlike some other stocks. There is no beautiful wedge. Let me see. Yeah. So that's what I have to say about Tesla is you really want to know where's your stop at and how far out are you. If I get anything on Tesla, it's 6 months or higher. I'm not day trading it. It's up too much already. And well, no, I'm sorry. You could day trade it if you wanted to, but I'm not. That's not the content I'm showing today. I'm looking strictly at a swing trade as because I think it's more profitable. You get your biggest moves in the gap ups. Like this is a prime example. This is a big gap up from 260 gaps up to 275. Okay, so if you're holding Tesla throughout these gap ups, then when the shorts have to cover, you're getting most of your gains from the gap ups, which is why I think swing trading season is back and you're going to get more swing trading those gap ups. And you just say, okay, where's my next resistance? Where's your next resistance for Tesla? Your next resistance is, I think if we break out of here, we blow past it. It's really 310. 310 is the next resistance. Some people will say 300, but 310 looks to be the next resistance. Above 310, well, I mean, 350 and then 400. So, and I think it does it rather quick with that video, right? Full self-driving is going to be the main catalyst to really get the stock going. You have a lot of other stuff also. And I'm not saying full self-driving is coming. Dang, Tesla looks strong today. What a nice wedge. Love the wedge. Let's see. But yeah, thanks, Hassan. When you see predictive patterns on Tesla, does it mean more algorithms are trading it? I don't know. I just think a lot of it could be algorithms. It is the most traded options. It is the most traded stock on the market when it comes to options. So these patterns that align, I think it's human psychology and algos and all the above. But pretty much the pattern's the pattern. And sometimes Tesla will do this though, so you got to watch out. It'll try to break out, it'll fail, and it'll actually make a new low, and that's when everybody gives up, and then it just catches a bid, and that's where the real focus is. Did it catch a bid? Is it sustainable? And it'll just start making new highs. I've seen it so many times. People give up, and that's why you have to have your stop, because it could stop you out and keep going lower. But a lot of times it'll come down, it'll break the pattern to the downside, catch a bid because there's a bunch of people FOMOing into Tesla. Given the supercharger network is now swallowing everybody else, they have to apply to the supercharger network. They're going to be using it. It could be a future subscription model for the supercharger network. And then you have the Cybertruck coming out in Q3. That's huge for revenue. They could be taking revenue from Ford and the trucking industry in general. So there's just so many catalysts. I didn't even name all the catalysts. There's so many catalysts for Tesla coming online. Yes, the stock's up a lot, but if you're familiar with Tesla, Tesla can run. It doesn't care. It runs up like a crypto, right? It runs like Bitcoin. Nothing else moves like Tesla in the stock market at this size of a market cap, because it has so much options and because so many people are short the stock. And hey, it makes for a big upside move. A lot of guys that we used to have in the past never came back. Ever since Tesla broke out, the guys who were bearish just never showed up again. Thanks for all the content you make and share. 100% Football Legends. I'm glad you guys enjoy it. Again, I appreciate you guys jumping on, supporting, and giving me the feedback. It does mean a lot, and I will keep on doing this as long as we can grow the community and it's bringing you guys value. As long as it brings you guys value, I'll keep on doing it. I've seen a lot of stories like this, unfortunately. Okay, whatever. So those are Tesla. That's AMD. Tesla did great work on lowering their cost for vehicles. I'm not Cybertruck fan. Yeah, a lot of people are not, but it's Elon. People will still buy the Cybertruck just because to show off or whatever. And maybe they like it. Who knows? Maybe it's a nothing burger. Either way, the lowering of costs gain market share. Now they can up the prices and increase margins because they have control of the market share. So that's why Tesla's so powerful. Yeah, that's the FOMC minutes. Does anybody have any other questions? Did I miss something? Did I miss something to go over before we meet up again tomorrow at 10 a.m. Eastern time? Oh, let's watch this video. If you're on YouTube, let's watch this video and we'll do some comments on this before we tap out of here. Yeah, come to YouTube. Or you could just listen to it here. Let's see which one looks better. Yeah, we'll do it like this. All right.
And there's a couple of numbers within the numbers that are important to point out. First of all, when it comes to average transaction price, up more than $1,400 compared to the first quarter. So they are continuing to see strong pricing with their vehicles. Also, their incentives and inventory, General Motors says they are.
Oh, you know what? My bad. Greta's mom. Thoughts on MU? I'll look at MU in a second, maybe. I don't really care for Micron, honestly. They got some restrictions in China, so I just don't trust that. I just don't trust MU because of the restrictions from China. And heck no, I don't want to mess with that. If they get lifted, it probably goes up a lot higher. Anyways, this is GM, by the way. This is just talking about GM, but I think they're going to shift into electric vehicles in general and revenues.
Flat, relatively speaking, compared to the first quarter. So that goes against the grain in terms of people saying, well, the market is going to be slowing down. We're going to see a huge surge in inventory. Certainly not what we're seeing as you take a look at shares of General Motors. And then let's transition over to talk about Toyota. Toyota reporting its June sales up 14.9%, including truck sales up 17%. When you put all of this together, and we'll get the final number either later today or tomorrow, the sales pace for the second quarter, GM thinks it's going to come in for the U.S. at 16 million. Now, if that's the case, you've got to go back at least a couple of years to see a sales pace for a quarter that was that high. Again, this goes against the grain in terms of what people were expecting earlier this year, guys. And I know a lot of people want to talk about EVs, and they're important in terms of a growth area for the auto industry. Still a lot of people out there buying those internal combustion engine vehicles.
I want to ask you a couple macro questions here. One, what does it indicate about auto buyers? I mean, you've got interest rates that are higher than they've been for the last couple of years if you're trying to borrow for a car. What does it mean about the appetite? And then the other part of this, Phil, is that we're watching all of these labor disruptions at West Coast.
They're worried about rates.
Don't care.
Pierce
I think investors are starting to realize that this is a company that I think investors are.
Yeah, Rivian, whatever. Okay, there we go. There's a Tesla news. That's what we came for. That's what we're here for. We're here for the Tesla news. We're not here to listen about GM and Ford trash companies. Sorry if I offended you.
180, it's a negative feedback loop turns to a positive feedback loop.
Mm-hmm. All right,
as far as Tesla,
go ahead.
Go ahead. I would say as far as Tesla, yes, there was a drawdown towards the end of last year, but it was more around I don't know that it was ever around the company fundamentals. It was around what's going on with Tesla's share price. Is their CEO selling to fund Tesla, to fund Twitter? It wasn't really around the fundamentals.
And remember, I made that video on TikTok. I guess, was it already a year? It was last year, where I said all this uncertainty has nothing to do with the fundamentals. Nothing has changed. Elon, it's just uncertainty and traders shorting the stock. So same thing here. Nothing changed fundamentally. Tesla's at a lower price now than it was in 2021. And yet the company is much bigger and much more profitable and has way more stuff in the pipeline. So this should be very interesting as the macro improves. And, all that macro stuff we talk about the market heading up. Well, S&P is not the best bet, or the Qs. It's going to be these big macro. I'm sorry. It's going to be these secular changes that literally change the world. It's technology. Who are the best technologies? Who have the biggest market share? Who has the largest TAM, or total addressable market? And I think Tesla has the bigger addressable market. Reddit's inventory is growing at a slower pace. Uncertainty not fully resolved. Bulls comfortable margin trough is near. Yeah, that's the other part. We're going to keep a track on this on Tesla earnings. Is can they trough on margins? Is the margins bottoming? Are their margins actually bottoming? That's going to be the key. Not only are they bottoming in this earnings report, but what is their guidance? The most important part of a stock's earnings report isn't just the EPS at all. EPS could beat, stock goes lower. EPS could miss, stock goes higher. What it is what are your margins looking like going forward? What is the guidance? And that's going to be key thing that we will probably go live and listen to if you guys want that on Tesla earnings day. We're headed for era that US exports more cars than Japan. Yeah, we might be there. We might be headed there. I think Toyota eventually has to use, I don't know if the Japanese culture will do this, but fully autonomous is the future, and maybe it takes a year, 2 years, 3 years, 4 years, 5 years, but eventually, Tesla's so far ahead. I think from a regulatory standpoint, they're going to have to lease out their full FSD to other automakers, and they'll be happy to do that.
And as Tesla's fundamentals have improved, I think that the stock has rallied, but it's a situation where you if you look at these two stocks, you've got one that's very, I don't want to say over-owned, but one owned from a healthy perspective, from a retail investment standpoint, that drives a very high multiple where expectations are very high. You've got a stock in Rivian where expectations have gotten very low over time, and now that those are just starting to increase, I think that's the time you want to buy a stock that's underperformed that can be turned into an outperformer.
So you have a hold on Tesla, as we said. I'm just curious, what role does competition for Tesla play in your skepticism?
Minimal. I think Tesla has a great future. From an institutional investor perspective, I look at the stock trading at 45 times my 25 numbers when I'm, factoring in 20-ish% EPS growth. I am willing to, put somewhat of a retail investor hat on and stretch the multiple, because that's the type of investor base that's here. But 45 times for 20% EPS growth, it just doesn't seem as great a fit for me at this point in time versus Rivian.
What little I know.
Basically, Tesla's overbought. Probably true compared to Rivian. Probably true. Overbought compared to Rivian. But you just never know. You just never know. I get it. You buy Rivian lower. Who knows? Everybody's structure in their trade and positioning is completely different. But when that full self-driving comes out, they're all getting crushed, right? Uber, Lyft, their businesses essentially disappear when full self-driving hits the market. And I'm a little optimistic about that because I believe in Elon Musk, and he has the best AI. By the way, if you want to compare all AI data and all robotics, they have the best AI machine. It's on the road. It's happening 24/7. You guys saw the video. Every hour, they're collecting so many billions of bits of data, and every car, it's a giant supercomputer. It's just a giant supercomputer. And Dojo, the supercomputer, is also making chips that are more enhanced than NVIDIA, obviously for the niche that they have. So anyways, bull case for stocks. Oh, we got this guy, the bull. Let's hear and then we'll be done. We'll hear the bull case for stocks. I always want to hear the bull case, obviously, because I don't want to hear no bear cases. That's depressing. No, I'm just kidding. We know the bear cases. Inflation goes higher. That's pretty much it. Inflation goes higher. That's the bear case. That's the only bear case you got. Everything else is revised higher. Growth is starting to trough.
A lot of investments are for 9% lower earnings in 2023 for the healthcare sector than in 2022, whereas the broader market kind of up 0.5%. So I think those are probably the better risk-reward sectors. I think
of Crossmark Global Investments into this discussion. Good to have you both, John. This really tees you up pretty well. I know that you've been pretty excited about a lot of the big index-type stocks coming into perhaps this part of the year. Now you feel like there's a little bit of a different risk-reward equation elsewhere in the market?
I do. Thanks for having me on this afternoon. So a couple things I would say. We had 3 down quarters in a row last year. The first quarter was negative, the second quarter was negative, and the third quarter was negative. And now we've had 3 up quarters in a row. And unfortunately, the way that the geometric compounding works, we're not back to flat. But all to say, we have had a significant rally, particularly in the tech names. And I totally agree with Adam's comment that the profit margins being more resilient allow those to be able to recoup those losses faster. Plus the fact the NASDAQ trailed the S&P by 1,000 basis points, peak to trough last year. So all that said very well for a massive tech rally. And then you got the AI cherry on top with NVIDIA's earnings and the multiple compression there. When I look at technology stocks, though, particularly semiconductors, those are now trading at the highest multiple in a decade. And if you look at that relative to defensives, for example, those had one of their worst years on record. So the utility space was trailing the market significantly. It had its worst year in 35 years relative to the NASDAQ that had its best year at the start of the year on record. But I would argue that even though defensives are getting cheaper, investors should be looking at small and mid caps. The small and mid cap space has not participated in this rally whatsoever.
Hey, I like that IWM. Palantir is one of those. Well, I don't know if they're considered small cap anymore. Maybe a mid cap. Wow, Tesla's pushing right now at the end of after hours. Are we getting the S&P push back up or the Qs? Not exactly. So, I I wanna jump in something. Got to stay patient. I'm gonna add to my AMD. Anyways, yeah, small caps. I agree with that. Defensive stocks, like nobody cares. Nobody cares if you're defensive stock. You want to get your dividend yield and grow at 7% a year. Great. Tesla, Amazon, Apple, Google, Facebook, they're growing at 50, 100% a year with no dividend. So you trust them with your money better than yourself, right? They're growth companies. The future is growth, mega cap growth, by the way. And hey, if you want to get some growth on the mid tiers, you got to do a little more research. You got to be a better savvy fundamental investor if you want to get long into these mid growths, right? Or you could just buy crypto, right? Because Bitcoin and Ethereum are going to return you, like a small cap. They're going to move like a small cap, yet they are mega caps and changing absolutely everything. But anyways, yeah, I don't want to get in. We're not going to get into crypto yet, unless you guys want to see that. I just want to hear. I agree with this guy though. Small caps, IWM still in a recession territory. Dow's above it. S&P's not in recession territory, and the Qs are not in recession territory. But IWM is. So if you can find a gem within the Russell, whoever the best companies are in the Russell, which I haven't really even looked into. I don't know if Palantir's still there. I think they are still there. Then those are going to be golden. I think Open Door might be there, and we already called Open Door back then at about $2.75. It's at $4, hit like $4.40. So we'll see how it plays out. Anyways, we'll finish what this guy has to say.
Whatsoever. And again, to echo a comment that Adam made, which I thought was very astute on that CPI, those small and mid caps were not able to pass through some of those inflationary pressures to the same degree. That being said, now you have the dislocation in valuations, and you have a situation where you could see earnings start to recover in the small and mid space. So I would argue that investors should look to those areas as well as utilities and banks. I think these areas have been massively dislocated. You have not seen the charge-off spike in the banks like many might have expected, and net interest margins are still holding steady. And if you look at REITs, for example, that's another area that I think is overly discounted. And you may be wondering, well, what if the Fed raises 25 bips more? My comment, if they're going to raise 25 bips more and that causes you to not be able to roll your debt and refinance at an appropriate level, you've got way bigger problems.
Yeah. Well, certainly that would be the case. You have bigger problems. I guess the big question is how much they've already been discounted. Victoria, how are you surveying things right now? I suppose the market as a whole.
Sorry, not interested in that. Anyways, okay, he didn't really say much. He's just bullish on the market. All right, I'm gonna get out of here. We went over the FOMC minutes, not much, nothing burger. Same thing. We'll keep track. We got service PMIs tomorrow. See how the service economy is holding up. Okay, is it still contracting? Is it still moving up? Is it still expanding? I'm sorry, not contracting. Labor market data next week. We start earnings next week. We have inflation. A lot of data to go over. I will be on early. 10 a.m. Eastern time tomorrow. You guys have a blessed day. Stay blessed. Keep learning. Keep a growth mindset. We'll see you tomorrow morning. And I appreciate the support.